Something just snapped in the silver market, and almost no one is paying attention. While most investors are watching the stock market, celebrating record highs, a much older, much quieter signal is flashing red in a corner of the financial world most people ignore. Silver, not gold, not stocks, silver. For decades, its price has been controlled, managed, some would say suppressed, but that control just broke. And what happens next could change how millions of people think about money, savings, and security. Stay with us, because by the end of this video, you'll understand exactly why the next 90 days may matter more than the last 90 years. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious, thoughtful investors understand the strategic forces shaping the global economy long before the headlines catch up. Before we begin, we'd love to know, where are you watching from today? Drop your city or country in the comments below. It's always meaningful to see just how far this community reaches. For more than 50 years, silver has lived a strange double life. To most people, it is simply a metal, something used in jewelry, electronics, and old coins tucked away in a drawer. But to a smaller group of investors and analysts, silver has always meant something more. It is one of the oldest forms of money in human history, used by civilizations long before paper currency ever existed. And yet, in the modern financial system, its price has rarely reflected that history. For decades, the price of silver has been set mostly by paper contracts, not by the physical metal itself. These contracts are traded on large exchanges, where investors buy and sell promises to deliver silver at a future date. Very few of these contracts ever result in someone actually receiving real silver. Instead, they are settled in cash, based on where the price happens to land. This system allows enormous amounts of paper silver to trade every single day, often many times more than the actual physical silver mined in a year. For a long time, this arrangement worked quietly in the background. Prices moved up and down, but the relationship between the paper market and the physical market stayed fairly stable. Analysts had a name for the normal condition of this relationship. They called it contango. In simple terms, it means that the price to buy silver in the future is usually a little higher than the price to buy it today. This makes sense because storing and financing a physical asset over time costs money, so future prices should include that extra cost. But recently, something unusual began to happen. The price of silver for future delivery started trading almost exactly the same as the price for immediate delivery. In some moments, it even dipped slightly below it. Analysts call this condition backwardation, and it is considered rare. It does not happen often, and when it does, it tends to carry a message. That message is simple but serious. Buyers are starting to question whether sellers can actually deliver the physical metal they are promising. This is not just a technical detail for traders to argue about. It is a signal that something underneath the surface of the market may be shifting. When futures and spot prices move so close together, it often suggests that demand for real, physical silver is rising faster than the supply available to meet it. In other words, people are no longer content to hold a paper promise. They want the metal itself. To understand why this matters, it helps to think about trust. Financial markets are built on trust. Investors trust that if they buy a contract for gold or silver, that contract has real value behind it. For most of modern history, the trust was rarely tested because very few people ever asked for physical delivery. The system worked because almost everyone was willing to accept paper as good enough. But trust, once questioned, tends to spread quickly. And in recent months, more investors, more institutions, and even some governments have started asking a very direct question. What happens if too many people ask for the real thing at the same time? Can the system actually deliver? This is the crack the title refers to, not a dramatic collapse, not a single headline event, but a quiet structural shift, visible only to those paying close attention to how the futures and spot markets behave toward each other. It is the kind of signal that professional analysts watch closely, because history has shown that markets often move in this direction before larger changes become obvious to the public. The question now is not whether this shift is happening. The data already shows that it is. The real question is, what is causing it and where the pressure is coming from? To answer that, attention must turn away from Western trading floors and toward a part of the world that is quietly becoming far more influential in setting the true price of silver than most investors realize. That story begins in the East. Halfway around the world, in trading rooms most Western investors never think about, a different silver market has been quietly rewriting the rules. For generations, the price of silver was decided almost entirely in two places, London and New York. These two cities house the exchanges that set the global standard. When a mining company sold silver, when a jeweler bought it, when an investor wanted to know its true value, they looked to these Western markets for the answer. This arrangement lasted so long that most people simply assumed it was permanent. Few questioned it, because for most of modern history there was no real alternative. That assumption is now being tested. In China, silver trades on an exchange based in Shanghai. For years, this exchange operated somewhat quietly, watched mainly by regional traders and a small number of international analysts. But recently, the price of silver in Shanghai has started to separate from the price in the West, and not by a small amount. At times, silver in China has traded 10 to 12% higher than silver in London or New York. This is known as a regional premium, and it is not something that happens without a reason. A premium like this tells a very specific story. It means that inside China, more people want physical silver than the amount currently available to satisfy them. Buyers there are willing to pay significantly more than the global benchmark price just to secure real metal. In a truly connected, free-flowing global market, such gaps are usually temporary. Traders would rush to buy silver where it is cheap and sell it where it is expensive, and the two prices would quickly move back together. But when that gap persists, week after week, it suggests something deeper. It suggests that moving physical silver across borders quickly and in large volume is harder than it used to be. This shift matters for a reason that goes beyond price charts. For decades, China and India together have represented the largest source of physical demand for silver and gold on Earth. Jewelry, industrial use, and personal savings in these two countries account for a massive share of global consumption. Yet, until recently, neither country had much influence over how the metal was actually priced. That power belonged almost entirely to Western financial institutions and their paper markets. Now, that balance appears to be shifting. As Chinese and Indian markets grow larger, more organized, and more closely watched by serious analysts, they are beginning to exert real influence over global pricing, not just global demand. This is a subtle but important distinction. Demand tells you how much people want something. Price-setting power tells you who gets to decide what it's worth. For most of modern history, those two things were separated. The East consumed, the West priced. That old pattern is starting to break down. There is another detail worth understanding here. Much of the recent strength in silver's price did not come from the large institutions that typically dominate Western paper markets. According to several market analysts, the major banks and large funds that usually drive short-term price swings were notably quiet during the most recent rally. They were not aggressively betting against the price, as they often have in the past. Instead, the upward movement appears to have been driven more by real physical buying, much of it originating from Asia. This detail is significant because it changes the nature of the signal. A price increase driven by financial speculation can reverse quickly, sometimes within days, but a price increase driven by genuine physical demand tends to behave differently. It reflects real people and real institutions choosing to hold a real asset, not simply place a short-term bet. That kind of demand is far less likely to disappear overnight. Put simply, the center of gravity in the silver market appears to be moving. Slowly, and without much public attention, pricing power is shifting away from the trading floors of the West and toward the physical markets of the East. For decades, this would have seemed unthinkable, but the data increasingly suggests it is already underway. This raises an important question. If demand from Asia is already this strong, what happens if that demand is allowed to grow even further, unrestricted? To answer that, the story must turn to a country where silver demand has not disappeared at all. It has simply been held back. There's a kind of demand that does not show up in daily trading charts. It does not appear in headlines or in the numbers analysts check each morning. It builds quietly, out of sight, until the moment it is finally released. Understanding this kind of demand may be the key to understanding where silver is headed next. Consider India. For generations, gold and silver have held a place in Indian culture that goes far beyond simple investment. They are woven into weddings, festivals, family savings, and generational wealth. Long before modern banking existed in most of the world, families in India were already storing wealth in precious metal, passing it down from one generation to the next. This tradition did not fade with modernization. If anything, it remained remarkably consistent, even as the country's economy modernized around it. But recently, official imports of silver into India have dropped sharply. This is not because the desire for silver has disappeared. It is because policy has intervened. Higher import taxes and tighter government restrictions have made it more difficult and more expensive to bring silver into the country through official channels. On paper, this looks like demand destruction. The import numbers fall, and at first glance, it might seem like fewer people want silver. But that conclusion misses something important. Restricting imports does not eliminate desire. It only redirects it or delays it. Cultural habits built over centuries do not disappear because of a new tax policy. What actually happens is quieter and, in some ways, more powerful. Demand does not vanish. It accumulates. It becomes what analysts often call pent-up demand, a kind of pressure that builds beneath the surface while official numbers appear calm. This is worth pausing on because it runs against how most people think about markets. Normally, when official data shows demand falling, prices are expected to soften. Yet, during the same period of restricted imports, silver's price did not fall. It rose sharply, moving from around $57 an ounce to nearly $65 an ounce in a matter of weeks. This happened while one of the world's largest silver-consuming nations was importing only a fraction of its usual volume. That is not a small contradiction. It is a signal. If price rose even while a major buyer was largely absent from the market, what happens when that buyer eventually returns? This is the real question worth sitting with. Restrictions rarely last forever. Governments adjust policy over time, often in response to changing economic conditions. When and if these barriers ease, the demand that has been quietly building could enter the market all at once rather than gradually. Markets tend to handle gradual demand well. They tend to struggle far more with sudden demand. There is a second related force working alongside this one, something analysts often refer to as capital rotation. In simple terms, this describes how large pools of money move between different types of investments over time. Right now, a significant share of global investment capital sits in a small number of very large technology companies. These companies are worth trillions of dollars combined, an amount that dwarfs the entire size of the global silver and gold mining industry many times over. Because the precious metals market is so much smaller in comparison, it does not take a large shift in overall capital to create a significant impact. Even a small percentage of money moving out of larger markets and into precious metals can noticeably affect prices, simply because of the size difference between the two. This is sometimes described as a small amount of water flowing from an ocean into a much smaller lake. The ocean barely notices. The lake rises rapidly. Evidence suggests this rotation may already be underway. Certain silver-related investment funds have started outperforming broader stock market indexes in ways not seen in some time. This kind of relative outperformance often draws additional attention from other investors, which can then reinforce the trend further. Taken together, these two forces, restrained demand in major consuming nations and early signs of capital shifting into precious metals, create a situation that is easy to overlook in daily headlines, but difficult to ignore when viewed as a whole. Neither factor alone would be especially remarkable. Together, they begin to resemble the early stages of something larger. To understand just how large that something could become, it helps to step back even further, beyond recent months and years, into the deeper history of money itself. To understand where silver may be heading, it helps to look backward, not just months or years, but decades, because the story of silver's price is really the story of something else entirely, the slow, steady decline in the value of paper money itself. In 1971, the United States made a decision that changed the global financial system forever. For the first time since the end of World War II, the dollar was no longer directly connected to gold. Before that point, the value of the dollar had a physical anchor. After that point, it did not. Money could now be created without being tied to anything solid underneath it. At the time, this decision was described as temporary. It was framed as a short-term measure to protect the dollar from financial speculation. More than 50 years later, that temporary measure has never been reversed, and the results of that decision are visible in the data. Since 1971, the US dollar has lost more than 85% of its purchasing power. In simple terms, something that cost $1 back then would cost many times more today, not because the item became more valuable, but because the dollar itself became worth less. This pattern becomes even clearer when comparing everyday assets to gold instead of currency. Take housing as an example. In 1970, the average home cost around 537 ounces of gold. Today, that same relative home costs roughly 140 ounces of gold. The price of the house in dollars rose dramatically. But measured in gold, it actually became more affordable. This is not because gold became magical. It is because gold held its value while the dollar did not. A similar pattern appears when comparing the stock market to gold. In the year 2000, it took about 40 ounces of gold to buy 1 unit of a major stock market index. Today, that number has fallen to somewhere close to 10. Analysts who study this relationship point out that if history repeats the extreme levels seen in past decades, the ratio could eventually approach 1-to-1 again. Reaching that level would require either a dramatically higher gold price, a significant decline in stock markets, or some combination of both. This is not presented as a guaranteed prediction. It is presented as a historical pattern, one that has occurred before and could occur again under the right conditions. At the same time, a separate but related pressure is building in the bond market, the market where governments borrow money. Recently, long-term U.S. government borrowing costs have risen to levels not seen in 25 years. This matters because governments, including the United States, currently need to borrow enormous sums of money simply to cover existing spending and refinance older debt. When investors demand higher interest rates to lend that money, it becomes more expensive for governments to manage their debt over time. Normally, when interest rates rise, the price of gold is expected to fall because bonds become more attractive by comparison. Yet recently, both long-term interest rates and gold prices have risen together, an unusual pairing that historically does not last long without a deeper explanation. One widely discussed explanation is that markets are beginning to anticipate that governments will eventually need to create more money to manage their debt, regardless of the near-term cost. Gold and silver have historically responded to that expectation long before it becomes official policy. None of this is presented as certainty. Economic history rarely repeats in exactly the same way twice. But patterns like these, currency devaluation, shifting asset ratios, and rising government borrowing costs, have appeared together before past periods of major financial change. Whether this moment becomes one of those periods remains to be seen. What the historical record does show is this. Throughout modern financial history, gold and silver have consistently served as a measure of trust in money itself. And right now, according to the data explored throughout this story, that trust appears to be quietly shifting.